This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, stepping in for Francine Lacqua. And here's what's coming up on today's programme. Pushing higher, European stocks, well, they tread water as Chinese inflation softens and traders await today's US factory gate report. The UK, meanwhile, setting out a package of post-Brexit finance reforms designed to spur the City of London. But for some, the plans represent a retreat from earlier ambitions. Rights issue bump. Credit Suisse shares open in the green after the Swiss lender secures its restructuring funds in a $4.3 billion capital increase. So yes, as we check in on the markets then an hour into the trading session this Friday, there is a bit of a holding pattern ahead of the producer prices, the factory gate prices out of the US, and what it tells us about how the Fed will react. CPI next week, and of course that decision on the 13th and 14th. And it's a glass half full, glass half empty kind of picture in China. Yes, inflation came off. That opens the opportunity for officials to shore up the economy with additional support, but it also points just to the weakness in the economy and question marks as to whether or not further easing in China can really do much as it battles to exit COVID-0. Across the benchmark then, as we said, range bound. The European stocks index, though, the benchmark here for those tech names, gaining 0.3%, had a little bit of optimism around what's happening in the chip space and the semiconductor space filtering through from the US session. The Bloomberg dollar index currently range bound, and here with Bitcoin, 70,206, just a gain of 0.1%, and the ripple effects of FTX continues, of course. And we know, of course, that SBF is facing multiple probes from the DOJ and many others. Across the map then, over in France, the CAC went down 0.2%. Range bound here in the UK, we have that story about an easing of regulations around the City of London. Nowhere near a big bang is the line from Lizzie Burden. We'll be continuing to cover that story for you. Over in Spain, gains of 0.2%, and in Germany, the DAX is range-bound as well. So yes, there are recession concerns, and to what extent the data then shapes the monetary policy response. And on China, China's consumer inflation did ease then in November as COVID disruptions suppressed demand, giving the central bank some room to ease policy. Meanwhile, Chinese property shares rallied on expectations that officials may add support for the ailing sector. That fed into, by the way, a sixth weekly set of gains for the benchmark and over in Asia, the MSCI Asia Pacific. But let's stay with China and bring in now China's economy editor, Jill Dices. Jill, talk to us then about the latest China inflation data and what it means for the future policy response from the PBOC.
Right. Well, really, we're just continuing to see that economic momentum weakening in November. Remember, this is before you saw this dismantling of COVID-0 this week, which obviously is going to take some time to take effect. So what was happening last month? There were still COVID lockdowns, growing outbreaks, record numbers of cases being reported. And really what that meant is that people are staying inside their houses. They're not spending any money. And so you're seeing, that continued cooling inflation data, especially compared with the rest of the world where inflation's been high all year. What that means for the PBOC is that they'll probably have some room to ease policy going into early next year. Economists are thinking maybe there's a benchmark interest rate cut on the table for the first quarter. Maybe you see them taking a look at that reserve requirement ratio for banks and easing there. So there are some options that policymakers have, especially because they are going to need it as the economy is continuing to slow down.
OK, so possibly a rate cut, a benchmark rate cut in the first quarter. We'll look for that and as to whether that comes through. Jill, when we look at the property sector and the number of regulatory moves that have come through in the last few days and weeks, what does it tell you about how convinced they are that they need to support this sector? Stocks are rallying. And is there a danger that they undo what many would say is the good work that's been done to address the bubble risks within that sector?
Well, certainly it seems like policymakers are taking a look at what's happening in the housing sector. They know that, again, along with COVID-0, this has been the other major drag on the economy this year. We're looking ahead to what's likely to be the Economic Work Conference next week. This is a massive meeting for policymakers in China, where we're hearing that they might stop using that phrase that's been battered around for the last few years, housing is for living in, not for speculation, indicating that they're likely going to take a look at providing some more relief for the housing sector going into next year.
OK, fantastic stuff. Bloomberg's Jill Dices breaking down the inflation data, the potential policy response, and, of course, what it all means for the real estate sector, the property sector over in China. Let's get more on the macro picture then, China, and as we look ahead to the US with Sree Kochugovindan, who is the senior research economist, I should say, at Aberdeen. Sree, thank you for joining us in the studio this Friday morning. Let's start with China then, and the window of opportunity it presents for the PBOC to try and stimulate and support this economy, and how that potentially clashes with a very messy exit from COVID-0. How effectful and impactful can that stimulus actually be within this new environment?
Yes, it's definitely a very tricky environment. They've made some very big steps towards reopening and towards moving away, exiting from zero-COVID strategy. But it's still going to be quite difficult because of the strains on the health system and because we are seeing rising COVID cases. There have been some key indicators we need to see. Vaccine rollout has to improve. The elderly, there's still not enough elderly population being vaccinated and covered there. So that needs to be improved. That is part of the policy. But it does seem that even with some changes, for example, home quarantining, the fact that we don't have to have mass PCR testing, these are all steps towards it, but still there are going to be those disruptions to activity that's going to continue, and that's really been weighing on the GDP outlook for some time now, and we expect that to continue for a while.
So link the China story then to your call that disinflation will be the key theme. How much conviction do you have as you look to 2023?
Yes, I think there are. If we look at headline, we're stepping away from China for now, because obviously China CPI we've just discussed, where core is very, very weak there, and that's again because of the activity situation. If we look elsewhere, very different story in terms of activity imbalances, the supply and demand imbalances. Now, the headline is likely to see a sharp deceleration because of the base effects from oil. Commodity prices in general, that's starting to unwind. Supply chains are improving as well. So some of those pandemic-related distortions and also the war-related distortions are starting to unwind. There's still some dislocations there. It will take some time, but the impact on headline will be quite sharp, so we'll see a deceleration. However, across US and UK, we still see a stickier picture for core inflation, and particularly core services, and that's where you're seeing new bottlenecks, in a sense, bottlenecks within the labour market, and that's going to be the key story for next year. Is
there a scenario where we have inflation coming down, but the labour market holds up, or is that an impossible scenario? How plausible is it that you get inflation coming down back towards the targets of the central banks, if not in 2023, then 2024, but you continue to have a resilient labour market?
I think that would bring a very challenging backdrop for central banks, particularly for the Fed. In the US, what we're seeing is, as a result of tight labour markets, we're seeing very strong wage pressures, and that's across the board, whether it's occupations, across skill levels, across different sectors, and in particular, where you're seeing, say, if you look at turnover data, quits, that's particularly high in transportation service sector. Again, this reopening, supply-demand imbalances are really focused across services. So because of that, inflationary pressures may still remain quite strong. So you could see a situation where, yes, other components are coming down, core goods prices are decelerating, in fact, negative in the US as well, on a month-on-month basis, but that services sector could remain quite strong. Services prices could remain quite strong. And will that be, what does that mean? A soft landing? Not necessarily. The Fed is going to have to hike even more aggressively. And that's going to be a trigger for potentially a deeper amount of economic pain, more jobs.
Right. Well, let's get. I mean, you're highlighting and you've said this in your notes that the services is absolutely key in terms of the trajectory of recession. But let's stay on the of inflation. But let's stay on the question of recession.
Yes.
We were speaking to HSBC Asset Management earlier in the show, and they said actually they favour Asia, and they think that the US is going to actually be in a pretty bad place in terms of the depth of recession. Do you like? It's a bit counterintuitive. Other people have said actually the US is in a much stronger position to kind of weather this storm. How deep is that recession likely to be, if indeed that is your forecast?
Yes, we are expecting the spillovers from the US recession, actually. So if the timing we're not so sure about, and we're not stuck to a timing. We have Q2 penciled in, but really what we're quite
Q2 penciled in for when the recession is beginning.
But what we are very confident, whether it's Q1 or Q3, what we're very confident about is that there will be quite a sharp recession in the US, and that's going to have spillovers across the rest of DM, definitely. Europe and UK already very, very poor leading indicators there, already in recession most likely. And then with Asia, I would say the slower pace of growth in China is really the key to watch there for spillovers. There'll be spillovers from the trade channel with US and Europe, but China is unlikely to meet the CCP target growth. It's going to be much slower growth. We've got 3.5, 3.7 penciled in for 2024. So again, very disappointing growth there. Not a contraction, but slower growth.
And reports suggesting they may set a target of 5%, which for many would be, and to you presumably as well, pretty ambitious for China. Just briefly on the UK, before we let you go, markets are starting to price a little bit less in terms of the BOE. We have the decision next week, December the 15th. 50 basis points, about 54 basis points being priced in by the markets, 100 basis points by February of next year. Is the market getting it right on BOE?
I think that more cautious tone is understandable, definitely, because you have that balance with the fiscal outlook as well. We're not seeing the same level of stimulus, say, in Europe that we've got some measures there to help with energy bills and utilities, but the real focus now, given what happened to the gilt markets following the mini-budget, we're really seeing fiscal consolidation and fiscal credibility. So there, it's a different sort of mix there. Inflation, we do expect, to reach around 11% early next year. So there is, again, this risk that labour market tightness is going to be a problem for the Bank of England. This is something we've seen reflected in a few speeches recently, and this fear of expectations becoming much more backward-looking as well. So it could be much more sticky.
OK, a challenge again when it comes to the labour market and inflation expectations, maybe 11% here in the UK. Painful still. Sree, thank you very much for coming to the studio. Great analysis and insights as we look at the response from central banks to this inflationary picture and questions about recession. Sree Kochugovindan, Senior Research Economist at Aberdeen. Coming up, Credit Suisse's wild ride continues with a $4.3 billion capital increase. More on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. One of the big corporate stories of the day, once again, Credit Suisse completing a $4.3 billion capital increase, giving the CEO the funds needed to carry out that all-important restructuring plan. Investors, they agreed to buy 98.2% of the stock on sale in a rights offer. For the analysis then, let's bring in Bloomberg's finance reporter in Zurich, who's been covering all of this really from day one, Marion Hoftermeyer. Marion, what does the capital increase mean then for Credit Suisse? How much room does it give them to breathe?
It gives them the room to breathe for the next couple of months to really embark on this big restructuring plan that they've announced. So they need the funds because they're going to be carving out their investment bank. They're going to be laying off employees. And they're also having to wind down assets they want to get rid of that are just too capital intensive. All of that will take time and money to do.
Yeah, I mean, there's been a drip feed, and you and the team have been covering it in terms of how they plan to restructure. But if we just take a step back and just remind us and the viewers of what that restructuring is likely to look like.
Right. So we have about 9,000 job cuts. That's across the globe and across the bank. But the large part of the restructuring really is this sort of shift from being a global bank that does all sorts of things to just focusing primarily on wealth management. And then with their investment bank, so that's, everything from deal making to advisory as well as trading, all of that's going to be shifted out and being less focused on. So we're going to be seeing what's called this new entity, Credit Suisse First Boston, being created to really house some of those businesses, and they're looking for external capital to help fund that business.
And will that allow them, within this restructuring, to return to profitability, and can that happen next year?
That's the big question, and they've had a hard time convincing investors on this and analysts. They've been very criticized for, how is this plan actually going to work? Markets are not helping, and the key business they want to focus on is wealth management, and they've had a lot of outflows in that business, so it's not looking super stable at the moment. The chairman and the CEO have both guided that they do think they will return to profitability in the next few years, but the next couple of quarters are going to look really shaky and really concerning. And we're going to have to wait a while to see whether the fruits of this restructuring are actually going to pan out.
Yeah, they have to stem the bleed. So far, the stock up 2.8% in the session. Bloomberg's Marion Halftermeyer on that important news around Credit Suisse. Thank you for the details and context. Now to the UK. The country has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. For more then, and the details, Bloomberg's Lizzie Burden. Lizzie, is it what we expected? Is there controversy? Anything standing out from you? Any additional risks in the financial sector as a result of these changes?
Well, Tom, most of this has been trailed. We know that Jeremy Hunt doesn't like to surprise markets. You've got about 30 measures, more than 30 measures this morning in 11 policy documents. But the ones that stand out for me are the new rules on short selling. That's moving away from the EU rules to the UK's own. And also this increased threshold that's going to be consulted on for ring fencing, as you say, from £25 billion an increase to £35 billion, which I should say applies only to small retail banks, but it's not in line with the SKIOC review, which had suggested keeping it at 25 billion. Conspicuously absent, though, from this morning's announcement are the words Big Bang 2.0, a reference, of course, to Margaret Thatcher's deregulation 30 years ago, because this is severely watered down from what Liz Truss wanted to do when she was Prime Minister, and indeed what the City Minister Andrew Griffith was talking about only a few weeks ago. We'll hopefully be speaking to him later today on Bloomberg TV. But we have already spoken to Chris Hayward, City of London Corporation Policy Chairman. He says this isn't Big Bang 2. It's not deregulation even. He says good regulation and good growth are two sides of the same coin. OK, the Conservative Party, of course, the ruling party, also kind of spinning this as the bounty of Brexit. Largely, as yet, arguably unrealised bounty of Brexit. Is it that? How linked is this to the exit from the European Union? Well, ironically, given the framing of this as the golden opportunity post-Brexit to create Britain's own rules, on ring fencing, for example, Britain didn't need to leave the European Union to change its ring fencing rules. It had actually gone further than the EU and many of its international peers on ring fencing. And remember, the financial industry in the UK grew as a member of the European Union. The UK played a big role in writing the EU's financial services regulations, and talent and capital have left London since the UK left the bloc. So really you have to ask whether it was the EU that was holding back UK finance. I'm sure that the Chancellor Jeremy Hunt and the City Minister Andrew Griffith, when they head north of the border, I think they're in the air as we speak, will want to address that and also assure investors that these measures are going to boost growth, but not at the expense of financial stability. OK, Lizzie Burden, thank you very much indeed on that important change. Even if it isn't Big Bang 2.0, significant nonetheless. We'll be listening out for the Chancellor later today. Coming up in the programme, European tech firms have faced a very challenging year so far. Coming up, we're going to hear about the state of European tech from the CEO of Atomico, one of the leading venture capital firms on the continent. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Tom Mackenzie in London. Let's bring you your Bloomberg First Word news. China and Saudi Arabia have agreed to hold regular summits, solidifying ties between the world's #2 economy and its top supplier of oil. In a meeting in Riyadh, Chinese President Xi Jinping and Crown Prince Mohammed bin Salman are reported to have agreed to upgrade the relationship to a comprehensive strategic partnership. The two nations also signed a slew of energy and investment deals. President Zelensky's diplomatic advisor has told Bloomberg that Vladimir Putin's comments about nuclear weapons
should be treated seriously. Commenting on the outlook for the war, he says there is no room for compromise with Moscow on the issue of Crimea.
As a last resort, there is a danger he may use this non-conventional weapon. By the way, not only nuclear, he once threatened about biological and chemical weaponry. So we all should be very serious about this.
US basketball player Brittany Griner has been released from detention in Russia in exchange for arms dealer Victor Bout, known as the Merchant of Death. While Griner's return was celebrated by many in Biden's party, the Democratic chair of the Senate Foreign Relations Committee called releasing Bout back into the world, quote, a deeply disturbing decision. Let's check back in on your markets. The benchmark here in Europe, currently up 0.1%. Some of the individual stories to bring to your attention. Credit Suisse managing to pull off a capital raise of $4.3 billion, enabling it to move ahead with its restructuring plan, being rewarded by investors in the session today. Santander being hit by a fine with regulators here in the UK, around £100 million, down 0.4%. And Total Energy having to write off $3.7 billion in terms of its linkages and investments in Russia. Plenty more coming up, including the pressure on Tesla and Elon Musk. This is Bloomberg. Pushing higher, European stocks edge up about 0.2% across the benchmark as Chinese inflation softens and traders await today's US factory gate report. The UK sets out a package of post-Brexit finance reforms designed to spur the City of London. But for some, the plans represent a retreat from earlier ambitions. Rights issue bump. Credit Suisse shares open in the green after the Swiss lender secures its restructuring funds in a $4.3 billion capital increase. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get from one of the big corporate stories, Credit Suisse, to another. While Elon Musk is, of course, busy overhauling Twitter, his most valuable company, Tesla, is facing increasingly urgent issues, testing the faith, then, of some of Musk's biggest fans. For more, we are joined by Bloomberg's Albertina Torsoli. And Albertina, why is the board, or at least why is so much wrath being faced by Tesla's board? Why are they coming under so much fire, particularly from their own investors?
Well, thank you for having me. This is, there's always some dramatic twist and turn with Elon Musk and Tesla and Twitter. Elon Musk has created this larger-than-life persona for himself. Twitter is the fifth company he's running, but he's just like the average CEO who will not be immune by shareholder angst if the stock doesn't do well. Take Tesla shares. Tesla shares are down 51%. This year. It's a big decline. The car maker is facing issues. These are not issues that, only Tesla is facing. The global automotive industry is under pressure for various reasons. Obviously, one of them is the slowdown in China. But Elon Musk is larger than life, and he's actually busy elsewhere right now. So that's where the issues are coming from right now.
Yeah, he is certainly larger than life. How is he deflecting some of this criticism then?
Yes, he is very active on Twitter, not only running the company and actually sleeping there right now because he's very busy working there. He obviously, he keeps busy elsewhere, oversees other things, and also tweeted that, just because he's not physically present at Tesla right now, this does not mean that the company isn't running well and dealing with the issues, the latest issues apart from the China troubles. There is a problem right now at a plant in Texas, a plant that is, the ramp up is slower than expected because of a battery problem, and this will probably keep the Tesla teams busy. He does have excellent teams, of course, and again, these are not Tesla only problems, these are industry problems. But the problem is, when you are an investor and you bet on Tesla, one of the reasons you bet on Tesla is because of Elon Musk. It's because of his narrative, his capacity to solve problems, to be everywhere, and not having them there right now, seeing him busy elsewhere, elsewhere, this is really adding pressure both on Elon Musk, on the shares, but also obviously on the board. One of the largest individual investors on Wednesday tweeted, Tesla's board is missing in action. So I think this is the reason for the tension we're seeing right now.
Yeah, and indeed. And of course, the situation in China really challenging for this business as well. We have a line crossing the terminal right now. Tesla will suspend Model Y output at its Shanghai factory at the end of December. That coming from Reuters. We'll see if we can confirm that. But it does point to the challenges in China. How troubling is the slowdown in that economy for the Tesla business?
Look, the slowdown is troubling for every car maker, not only Tesla. The problem right now is that they had, the chief of their China operations, a very good executive, has just been taken and sent to deal with the problems in Texas. So once again, there's a sense that there is a bit of a vacuum right now at a crucial time for the company. Again, this is not only a Tesla problem, it's a wider problem, but all other CEOs are, 24/7 dealing with that problem. And the sense is that Elon Musk is busy elsewhere. We'll have to see how 2023 pans out. It's a problem in China. It's a slowdown in China, but don't forget that the China situation also has led to other supply chain problems. There's logistics problems. There are all kinds of problems elsewhere. And of course, a recession or possible recession next year in Europe. So a lot of pressure on Tesla, on other car makers. But again, investors want to see him there and are asking for a buyback. It's taking longer than investors want to get a buyback to prop up the shares. So I think 2023, the end of 2022 and 2023 will be interesting for Tesla and the industry.
Yeah, and absolutely. And Musk, of course, has hinted that maybe he would be in favour of a buyback. But as you say, a multitude of headwinds at a time when his attention is split. Bloomberg's Albertina Torsolo, thank you for the analysis on that story. Now, European tech firms have seen their combined value fall by nearly $400 billion this year to $2.7 trillion. That is according to VC firm Atomico's latest State of European Tech report. I spoke to Atomico CEO Nicholas Zenstrom and began by asking him the reasons behind this year's setbacks.
What we're experiencing is a trickle effect, or what we have been experiencing, a trickle-down effect from the public market, and primarily where crossover investors, hedge funds who have disappeared from the growth market. And as a consequence, companies looking for growth investments, they're struggling to find growth investors. So of course, valuations have come down, and on Series B, valuations come down about 57% from the heights of this year in Europe. Series A, 62%, and the volume is down 30%. So will it go down more than that? It's like, we don't know. But I think we're back now to valuations that we had in 2020, so kind of around when the pandemic started. So I think valuations are more normalized now.
So valuations are normalized, but have they bottomed?
Who knows? I think because there's been so few investments, what's happening now is that founders who have runway, because they raised so much money last year, they've not been out in the market to test the valuations. So, but we'll expect them to be out raising next year. And I think that this last few months and probably beginning of next year, the market's going to try to figure out what the valuations are, where founders maybe have expectations of higher valuations, but investors are going to be, looking at historical averages. But what I do think will happen, though, is that there's so much dry powder in European venture capital investors and growth investors. It's over 80 billion. That's what was on the numbers that come out from our report today. 80 billion in dry powder. So venture investors are in business. They want to invest in companies. But what they will do is to have a higher focus on high-quality companies and high-quality teams. So what I expect to see is that the really good companies is going to be very competitive.
Where does that you talk about the $80+ billion of dry powder that the venture capital industry in Europe here has. Where do you expect that to be deployed in the months and years ahead? Which particular themes, segments, sectors are looking most attractive for that dry powder?
I think what we will see, investors are going to be looking at primarily at type of companies when they can see a sustainable growth, and they don't need to have profitability, but where they can actually look with more scrutiny on the business model, like will the unit economics works, will they be able to get good profit margins and so forth. There was a lot of venture capital money that went into marketing war and to fuel growth. I think we will not see much of that. And what we're also starting to see more and more because what we look at is the seed stage investors and company formation. And what's really been exciting to see over the last half year is that more and more entrepreneurs are starting companies to address the climate crisis. And they're seeing a problem, and they see therefore an opportunity to solve that. And there's a range of different technologies for that, but that's clearly a trend that we're seeing.
OK, that was Atomico CEO Nicholas Zenstrom on the challenges facing this tech sector as it squares up to 2023. Coming up, wild wins and staggering losses. If you put your money on some of the World Cup's unlikeliest outcomes, how much you've actually made? We're going to be live from Doha with some answers. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, what a World Cup it has been, with all the controversy about being hosted in Qatar, but there have been some shocks and stunning wins, of course, and we are all looking ahead, at least I am, to England versus France, slightly quaking our boots about Mbappe. Joining us now, though, for a prediction on the ultimate finale is going to be Joachim Clement, who is an investment strategist at Liberium and has built an economic model that predicts, at least you claim, Joachim, predicts the outcome of the World Cup. And to give you your credit, you've done it successfully, 2014 and 2018. Talk to us about what your prediction is for this year. Are England going to do it? And what is behind this economic model?
Well, the good news for England fans is England is going to make it into the final.
And win.
No, the bad news is they're going to lose this one. They've been in one before, they won that, but this year's prediction from us is for Argentina to win. And it is based on, as you mentioned, this economic model that is based on some economic factors that, quite frankly, I produced 8 years ago for the first time in a way to satirize economists' hubris in trying to predict absolutely everything. And then actually I was right twice in the last 2 World Cups in predicting the winner.
So it turns out that actually predicting the World Cup winner is easier than predicting inflation?
Definitely, it seems. At least this year, it seems to be much, much easier. It points to a truth when it comes to World Cup, namely the fact that while there are a lot of upsets, and trust me, I've been sweating a lot after Argentina lost against Saudi Arabia in the opening match, there are some really important factors at play that make a team good. And they don't necessarily have to do with the individual players, but with the infrastructure in place.
So talk to us about that then. That is really interesting. I know you started this as a bit of a nod to economic forecasting and how fallible it can be. But what are the components that you've built into this model then? Yeah,
so there are essentially 4 components that are in the model. Number 1 is the temperature, the climatic conditions. You have countries where you can play football all year round are clearly at an advantage versus countries where it's too cold in winter or too hot in summer. Then you need a lot of people. The more people you have, the bigger the talent pool that you can select from, and the more likely it is that you will produce stellar players. And then the third question is basically what we use is GDP per capita, the wealth of a country. If you are too poor, look at Nigeria and other African countries, they might have a massive talent pool, but not the money to put the infrastructure in place to actually develop these talents and become world-class players. And then fourth is a cultural phenomenon. Countries, particularly in Latin America, are much more football obsessed, and they have an advantage because that means more people are playing the game and you have more talents.
So it's a cultural aspect as well. I'm going to throw in a country that ticks at least 2 of those boxes, wealth and a large population, that is terrible at football, and that's China. They didn't even make it into the world. I can't remember the last time China has qualified. Massive fan base. They love the sport. They have their own teams. So what's going on there?
Yeah, it's indeed true. China and India are the two countries that should, on the face of it, do really, really well. The Indians have decided to play cricket, God knows why, and the Chinese, for some strange reason, have never really caught up on that. China is the big outlier in this kind of model to the negative, in terms of not being as successful as they should be, while there are other countries, and I particularly point out the Netherlands, a country that is relatively small, but has been incredibly successful at football over the years and decades.
So what are you going to do if your prediction is England, Argentina in the final, England ultimately lose, Argentina win with Messi at the helm? If that doesn't come to pass, what is your kind of what are you going to do? What is your reaction to that? Have you kind of made a bet within the office?
Yes, well, I've participated in our office raffle, and we got our tickets attributed at random, and I got Ghana, so I'm out of the race already. But I've, in the note itself, actually claimed all the excuses that I can have. After all, I'm an economist with more than 20 years' experience. I'm good at excuses. And the number one excuse is, which makes this World Cup so much harder to predict, is the fact that it is in winter, not in summer. So it's in the middle of a season where some players are much more rested than they usually are when we play it in June or July.
It was interesting. So I was looking, there are other models, of course. I mean, and you're going to stick by yours because of the way you've built it. But there's the Alan Turing Institute. They're giving Brazil a 1 in 4 chance of winning. The UK, or England, I should say, 1 in 10 for England. That's the Alan Turing Institute. And then Lloyd's, they put together the collective insurable value of teams' players. And they predict England are going to win versus Brazil in the final. And they got 2014 and 2018 right as well. Anything to say for those models?
I do understand their approach, and there's a lot of merit in them. I'm a bit cautious about using the collective value of the players because the Premier League has so much more money at its disposal and can pay so much more for players that it is a bit skewed in that respect. But there are different approaches. I, as an economist, used the macro approach. That has turned out to be rather better than I expected. To be honest, I'd be happy if the hype dies down a little bit and I for once get it wrong.
Well, let's hope you do, and let's hope England end up being victorious. What is easier to predict, then? Is it the World Cup, or is it the shape of these equity markets?
It's hard to say, to be honest, because I always thought equity markets are easier to predict than the World Cup, but it turns out that World Cups statistically are easier to predict because there are fewer upsets. But when it comes to the current market outlook, I would say I've got a lot of confidence in some aspects of it, but trying to forecast when this market is going to bottom is just as impossible as whether France will win against England or the other way around. OK, we're going to get you back in when England are triumphant against Argentina in the final, and you can dust off some of those excuses you've been preparing. And I will bring my humble pie, yes.
Joachim Clement with the potential for that humble pie. Thank you very much indeed. That was a lot of fun. Investment strategist at Liberium, of course, has built this economic model around predicting the outcome of the World Cup. He forecasts Argentina win the final versus England. There is plenty more coming up, of course. Just briefly checking in on those markets that I touched on there with Joachim. Currently, across the benchmark European equities, you're seeing on the stock 600 gains of 0.2%, and futures in the US just about holding up. It's all about the producer prices today. Stay with us. This is Bloomberg. We're going to get more on the UK as it unveils a package of post-Brexit reforms aimed at juicing the financial services industry. We bring you the details. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. A redhead crossing the terminal now. We know, of course, the Chinese economy is under pressure. They're wrestling to exit COVID-0. Now the redhead that the Ministry of Finance is stepping up with some additional support. They will sell 750 billion yuan of 3-year special sovereign bonds. They'll do that on December the 12th to aid the economy. That is according to a statement from the Ministry of Finance, as we continue to watch for further levers that policymakers in Beijing are likely to pull to put a bottom under this economy. And our reporter out of Hong Kong suggesting that maybe a benchmark rate cut is in the offing in the first quarter. But so far, you're getting a sovereign debt sale to help pump liquidity into the Chinese economy on December the 12th, 750 billion yuan. Right, let's get the Bloomberg Business Flash now. And Credit Suisse has completed a 4 billion franc two-pronged capital increase, giving the bank the funds needed for a comprehensive restructuring. Investors agreed to buy 98% of the stock in a rights offer, raising more than 2.2 billion francs. The remainder of the shares will be sold in the market. US regulators are seeking to block Microsoft's $69 billion acquisition of games publisher Activision Blizzard. The Federal Trade Commission says the deal could curb competition in the gaming market by limiting rivals' access to the company's biggest games. The transaction would turn Microsoft into the number 3 gaming company behind Tencent and Sony. China Eastern Airlines has become the first recipient of the Chinese-made C919 passenger jet. The delivery is a milestone in the country's aviation ambitions as it looks to take on Airbus and Boeing and follows years of planning, testing and delays. The C919 is due to start flying commercially next spring. And that is your Bloomberg Business Flash. Let's get back then to the changes in the City of London here in the UK being announced by the government. The UK has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden of smaller banks. For the details, let's bring in Bloomberg's Joe East. And Joe, how significant is this step? Lizzie Burden's been telling us that government officials, don't want to brand it as Big Bang 2.0. So does it really matter?
Yeah, I think it's massive news, really. I mean, so pre-financial crisis, banks were basically taking retail deposits and putting them into their investment bank. And that led to a contribution towards the financial crisis eventually, because you had an explosion in derivative trading and investment banking. So when the banks came into trouble in the financial crisis, they announced that they had to separate those two things. And that was massive news. I mean, I was at uni at the time. I remember when we learnt about this, and it was like, this is going to be a big change. This is going to change everything. So this kind of is a very risky thing to do. And I mean, I think that it kind of feels like a bit of a Jacob Rees-Mogg policy. Maybe he's in the ear of Hunt and Sunak, you know, his ex-hedge fund background. It seems like something that the ERG maybe had an influence for me.
OK, interesting. And then, as you say, there's a risk component as well there that will be scrutinised, no doubt. When it comes, talking of risk, short selling, that's being looked at as well. What are the details there? Yeah, so essentially, at the moment, you can short sell in the UK, but you can't naked short sell. And this is where you basically agree to sell a stock before you've actually borrowed it. And essentially, this inflates the short position on any security, because it means that there could be more securities short than are actually in existence. Gets a bit technical and a bit wonky, but essentially it means that there's more downward pressure on a security, and it means heavier selling. And that creates a lot more risk. And essentially, that's not going to be scrapped, but it's going to be reviewed. They're asking for people to give their thoughts, people from the industry, what they think, and we could see that rule dropped. OK, so watching the short selling rules as that review is underway. More broadly, you take a step back, Joe, and we're looking at the financial sector and the City of London losing its crown when it comes to stocks listings to Paris, for example. How do you play this all into that? Where is the City of London at this point?
Yeah, so this news that we're having today is really coming at a time when the UK's Brexit decision is coming under more scrutiny than ever. Yeah. And I think this is really because the inflation situation in the UK is worse than elsewhere. So people are looking at that and thinking, what's the reason for this? And they're thinking it must be Brexit. And also at the same time, you've had the market cap story that you mentioned there. And also some commentary from, I remember Lizzie Burden had a Bank of England member talking about the cost of Brexit. We had the Euronext guy on this week saying that the UK has lost its place as Europe's leading financial centre. So there's so much pressure now to put London back on the stage, and I think this is definitely playing into the government's decision.
Joe Easton, thank you very much on these important changes in the City of London. There is plenty more coming up. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York, Anna Edwards here in London. Your futures in the US pointing higher by 0.2%. This is Bloomberg.
Markets lead the economy. And what they're telling us is that next year, the first half of next year, is going to be a difficult period, both in the U.S. and in Europe.
I think the U.S. economy is going to prove to be more resilient than that.
We've never seen a recession so anticipated. And it does make you, I spent a lot of time on Wall Street, it does make you seem to think, well, maybe I should take the other side of that.
If you think the bear market is not over, I get that, and that's one thing. I think the lows are in. And I think we're starting a new bull market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. What will the Fed do next? Investors hope key inflation figures out today may provide a clue. The big freeze. Europe may be able to fight it off because of huge stockpiles of natural gas. And the UK unveiled more than 30 post-Brexit reforms aimed at boosting the financial services industry. What will the so-called Edinburgh reforms mean for UK finance? Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kailey Leinz is off today. And Matt, we heard a lot of divergent views there at the top of the programme about where markets go from here towards the end of the year into next. But today, it seems, yesterday and today, markets trying to close out at least this week better than we've seen at the start of December.
Yeah, absolutely. It does look like we definitely had a gain in the cash session yesterday in the U.S., and we have a gain in futures today as well. We have some kind of conflicting stories in terms of the outlook for markets next year, and we're going to dig into those throughout the program. Take a look first off at what's going on in Asia. We're seeing gains across the Asia Pacific. This is the MSCI right now, up 1.25%, and the Hang Seng is gaining 2.33% as well. So some decent gains there. The Nikkei closing up more than 1% in Japan, and you can see the yen here, the U.S. dollar at 136, buying 136 yen. That's fewer yen than it bought the day before. So definitely risk on in Asia, and that carries over to U.S. futures as well. Not quite as much right now. S&P futures up about 0.2% because we were up over 1% at the close of the cash trade yesterday, and we're still not back to the 4,000 level that we dipped below at the beginning of this month. The 10-year yield coming up just a little bit, still under 350 right now, so 348.69 is the level there after we had climbed to a record 4.25 a couple months ago, at least for this cycle. And then you see NYMEX crude right now up 1.4%, but still at 72.45. So still at levels that we hadn't seen before this week since 2021. Very low level relative to what we've seen throughout 2022 for crude oil. The same is true of Brent. Finally, take a look at Bitcoin, up again over 17,000 and holding at that level. So the stability, I think, since the fall of the FTX exchange, in fact, the climb since really Bitcoin was revalued after that implosion is pretty impressive, I think, to anyone watching, although Coinbase may be trading down a little bit in the pre-market. Anna, what do you see in Europe?
Yeah, European equity markets then making fragile gains, modest gains for this morning, up by around 0.2% in the UK and over in Germany. Wall Street then benefiting yesterday from maybe some cracks emerging in the labour market story. And we look ahead to PPI data later on today, that coming ahead of the CPI data next week and the Fed meeting next week. All of that will add up to an interesting picture going into the Fed meeting. And so we see markets kind of in limbo, waiting for a bit more clarity on where the inflation picture and the US economy goes, perhaps. The China story overnight with the slight weakness in the inflation data there, adding to expectations of stimulus. That helped at the margin. Brent crude then up at 1.25% this morning. I put this in because we keep seeing this time of the day that Brent crude is higher, even though the numbers look a little bit low. There seems to be a daily pattern of what's happening in crude markets right now. 85 is where we started the week. We have lost a lot of ground since just the start of this week and actually trade pretty close to the area we traded at the start of this year. Remember, we've been up much higher than this during the course of 2022 with all the geopolitics that has been playing out. Credit Suisse up by 3.2% this morning. They have managed to put away their rights issue. More than 98% of those shares of the 4 billion Swiss franc rights issue they managed to do that's going to fund restructuring. More than 98% of those going to existing shareholders. Man Group, this is the biggest gainer on the Stock 600. The listed hedge fund up by 6.6%. They are doing a buyback, and that is proving positive for investors. And I put in the euro, Matt, 105.58. We have no movement on euro dollar today. But of course, we look ahead to a lot of data out from the US and to the Fed next week and the ECB next week. I spoke to Elsa Linios at RBC earlier on, and she had a really interesting angle on this, saying there's a sort of transatlantic divide, a home bias going on when it comes to assessing the state of the US versus the European economies. And European economists and therefore FX traders are more positive on prospects for the euro right now. We'll see what the data over the next week or so reveals.
All right, very interesting stuff. Now, investors are going to be watching closely, speaking of data, today's release of the U.S. Producer Price Index for clues on inflation and how the Fed may react. The numbers come out at 8:30 a.m. New York time. DWS Group's Greg Staples spoke with Bloomberg on his inflation outlook.
We also think longer-term inflation is going to be above the 2% that the Fed is targeting. I do think that that inflation-unemployment trade-off that the Fed has to deal with, they will settle for a higher rate of inflation if that means we can keep unemployment at the 4.5%, which I think is the narrow rate.
Our markets reporter Valerie Teitel is here to preview the PPI number. And Valerie, this could change the calculus for the Fed next week. I mean, is it that big, or do we wait for CPI to make the real move?
No, I think it really does, Matt. I think a lot is really undecided for what the Fed's going to do, especially where they put that 2023 dot, which most of us view as where they're going to guide the terminal rate for next year. The PPI data today, it will give us a hint on how steep a drop of goods inflation we might expect to see in next week's CPI print. As we know, goods inflation is what PPI normally tracks quite closely. That was really the first to explode in 2021 based on, the commodity price rise, based on all the supply chain pressure as we came out of the COVID era. But really, the important thing is how quickly will this steep drop in goods inflation feed into core services. In my next chart, I'll show you how the handoff has been. It's been almost a year of declines in core goods, the year-on-year inflation metric. But really, we've yet to see that reflected into core services. And Matt, these are things like wage price inflation, the stickier components such as rent. Those have really have not turned around, and Powell has reiterated over and over again they will not pause, they will not pivot until they are sure that this core services metric has peaked. So let's see if the PPI data today gives us some hint on how the flavor of the CPI number will come next week.
Okay, there's a lot to talk about when it comes to inflation. Then, Valerie, thank you very much. Bloomberg's Valerie Teitel with the US data. Of course, we had Chinese data overnight as well. Now, Europe is bracing for an unusually cold winter, adding more pressure to already soaring energy prices. Bloomberg's European correspondent Maria Tadeo joins us now in London to take us through the latest details. We've all become meteorologists of late, Maria. What does this cold weather, and it has become quite cold here in London, to say the least, of further north. What does this cold weather then, what does it mean for Europe?
And we have to talk about the weather, and it's not in my case, because I've been in the UK, so now I've turned into a full-on Brit, is because this year it really does matter, Anna. And look, it has a lot of repercussions. If it gets very cold, obviously, it means that you draw from storage because you want to heat up your home, you want to heat up your place of work. If you draw from storage, that brings potentially the idea of rationing. That means blackout, and that means, again, the specter of recession in Europe. So I think today there's two real key messages that are coming out from two of the biggest economies. The Germans are saying, the regulator, be very careful about the amount of heating that you're using. We need to be much more responsible on this. And that the French president is suggesting we don't have to panic over blackouts, but we have to be responsible, use common sense with this cold snap. But again, we'll have to wait and see. Of course, if it's cold, you want to turn up the heating.
Yeah. What is then the policy response, Maria?
Matt Miller, my friend Matt Miller, good to be with you on this show. It's been a long time. And Matt, you lived in Berlin. You know it gets very cold there, but then you also know politically there's a fundamental issue that Europe has not come to grips with. And until you fix this debate, you're not going to get a policy response, to answer your question. And the dilemma here is, what matters most? Is it supply or is it the price signal? When you talk to the Germans, they say the key here is supply, especially as you look for storage for next year. When you look to the Italians, they tell you what I care about is cheap. It's a price signal. I need energy, but I can't pay at all the amount of money that the Germans are willing to pay. So until you fix that point, you don't get to a decision. We have an energy ministers meeting on Tuesday. The expectations for that is very muted. And then at the end of next week, European leaders will meet again in Brussels. Can they infuse political momentum on this? That's a question to be seen.
Yeah, I want to point out as well, we're going to be speaking to the CEO of Mercedes-Benz, Ola Kalenius, at 8 o'clock New York time. I'm going to ask him, Maria, what does Mercedes do if Germany implements rationing for factories? Because obviously a lot of their operations run on gas, and they're going to need to rethink their plan.
Can't wait to hear it.
Yeah, that's going to be interesting. Maria Tadeo, thank you very much. Maria Tadeo with us in studio here in London, taking us through some of the themes we will watch around regulation, rationing, price signals around the energy story. Now, the UK has revealed a package of post-Brexit reforms to boost its financial services industry, with changes including relaxing ring-fencing capital rules to lighten the burden on smaller banks. For more, we're joined by Bloomberg's Lizzie Burden, who has details. So, Lizzie, we've heard quite a lot this morning from the UK Treasury. Some of it had been trailed. Did we hear what we'd expected?
Well, yes, Anna, you've got more than 30 policy measures here, lots of reviews, but as you say, most of it trailed. As we know, one thing about the Chancellor, Jeremy Hunt, is that he doesn't like to surprise markets. But two things really stand out for me. The government is looking to increase the ring-fencing threshold by £10 billion to £35 billion, so not in line with the SKIOC review, which said it should be kept at £25 billion. And it's also looking to introduce the UK's own rules on short selling instead of the EU ones, and that would include consulting on scrapping a rule on naked short selling, so really playing into the hands of hedge funds here. But while these measures are significant, this is a real
naked short selling would be allowed?
It's being consulted on, but the point really is, in the big picture, this is really a watered-down version of what we had been hearing about under Liz Truss, and even only a couple of weeks ago, Matt, when the City Minister, Andrew Griffith, was briefing, we were hearing about a Big Bang 2.0, but that's not even in the language today. And the reason is that much of these reforms have had to be scaled back. They're now going to be known as the Edinburgh reforms. You've got the Chancellor and the City Minister in the sky as we speak, on their way north of the border to address CEOs.
Wow, so that's cool. I'd be allowed to sell shares that I don't own or even have possession of. Amazing what can be achieved, I guess, after Brexit, right? Is this all what the UK can do post-Brexit?
Well, it's certainly being framed that way by the government, Matt. This is being framed as the golden opportunity to deregulate, having left the European Union, but not everyone agrees with that framing. Take a listen to what Pat McFadden, Shadow Chief Secretary to the Treasury, told Anna and me yesterday.
The truth is that to support this sector, if they were really serious about that, it might have been an idea to think about market access for it when they were negotiating their Brexit deal, but they failed to do that.
Now, ring fencing, of course, is an area where the UK went further in its regulations than the EU, so it didn't need Brexit to unwind those rules. But the message that the Chancellor is going to want to hammer home later today is that these measures will boost growth, but not at the expense of financial stability.
All right, Lizzie, thanks very much for joining us. Lizzie Burden there. She's going to be speaking with the UK City Minister, Andrew Griffith, later on today. So that's an interview you don't want to miss, especially if you're focused on the city. Let's get a look right now at some of the stocks moving in pre-market trading in the U.S. First off, Microsoft and Activision, after the FTC takes a look at this $69 billion buyout, potentially putting it at risk. You can see Activision Blizzard shares are down right now, only about two-thirds of 1%. And Microsoft really unchanged, but still a big story to keep your eye on. And if regulators rule that you can't own the most important video game because you're not letting other people in on your IP, that just raises, I think, a question about IP for so many other things. Take a look at shares in Tesla right now, unchanged. There is concern among Tesla investors that Elon Musk, the CEO, maybe has too much to do with his job at Twitter as well. And there are issues popping up at the car maker that need to be addressed by an executive. Coinbase is down as Mizuho downgrades it to an underperform, saying they're concerned about volumes in trading there. And then DocuSign with a big jump this morning after results beat the street's estimates. DocuSign up 12% in the pre-market. Anna?
OK, some decent movers to watch out for then there. Let's get back to the macro themes and tell you that coming up on the programme, Kokou Agbo-Bloua joins us, Global Head of Economics and Cross-Asset Research at Societe Generale. What clues has he been taking from a weakening in the inflation impulse in the United States, maybe later in PPI and next week in CPI, and certainly from overnight in China? We'll get to all those themes. We'll also speak to Kevin Daly of Goldman Sachs as they've set out at Goldman Sachs to gauge the world economic outlook through 2075. They must be taking a very long view. Do we need a new economic model if you're looking that far ahead? We'll be back shortly. This is Bloomberg.
It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, on Tuesday morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
The power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report Tuesday morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. Kailey Leinz is off today. We have a story today on fund managers that I just think is so telling about the buy side versus the sell side. Remember earlier this week, strategists predicted a drop in stocks next year for the first time since 1999. They haven't been that bearish about next year's performance on the S&P 500 for over 2 decades. So Bloomberg reporters got on the phones and called fund managers around the world to see what their take is for next year. Well, fund managers are expecting double-digit gains in 2023. I guess it takes two sides to make a market, right? Joining us now is Lynn Thomason, Bloomberg Markets managing editor. Lynn, why are fund managers, why is the buy side so bullish about 2023?
Yeah, absolutely. I mean, I think, when we're talking to fund managers, they're possibly looking at these cheap valuations and especially getting into these more defensive areas as something that could carry the market. I mean, clearly we've seen a massive rotation into energy and out of tech this year. And so I think part of what you're seeing is some bottom fishing among the investors and perhaps strategists looking at the macro picture and saying it still looks a little bit bleak.
Right. I mean, Lynn, when you look at where we have seen enthusiasm, as you nodded to there, energy stocks have been very popular, of course, this year. Now JP Morgan's Kalanovich saying sell energy stocks from here. This seems to be the basis of their bearish call.
Yeah, and I think what they're looking at is this divergence in energy prices. So energy prices have started to soften, and yet energy stocks have been really strong. So I think what JP Morgan is saying, this can't quite last forever, and we might see a dip in energy stocks.
It's interesting, when you look at oil, Lynn, you see this argument playing out between a reopening in China, that would arguably be good for demand, or a recession due to central bank tightening around the world. That would cause a recession. How do you see that playing out in equities?
Yeah, I think that's exactly the tug of war that's in markets right now. Is it good news because China is coming back, or bad news because we're going to face a global recession? I think, essentially the picture is kind of muddied. And to your point earlier about the divergence between strategists and fund managers, it's exactly that split in the market.
OK, Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the different views that, as Matt says, make a market. Let's just tell you where you can find more market analysis, of course. MLIV Go is the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
China is rapidly abandoning the tough measures which have defined its COVID-0 policy. But as Bloomberg's Stephen Engel explains, little time has been spent putting in place mitigation measures needed to deal with the expected resulting explosion in cases.
While Hong Kong has served as a blueprint for China's opening up from COVID, it's also a huge, huge cautionary tale. Now, when the Omicron variant swept through this modern city of 7.5 million earlier part of this year, the city's sophisticated healthcare system was simply overwhelmed. At one point, Hong Kong had the world's highest death rate due to COVID. There simply wasn't enough space to put all the patients or bodies. Some of the sick were put outside on gurneys as body bags with the deceased stacked up in some wards next to the infected living. Morgues, too, were inundated. Most of Hong Kong's nearly 11,000 total COVID deaths happened between February and April of this year. Like Hong Kong, China has a largely under-vaccinated elderly population, but on a much, much larger scale. And China, too, doesn't have the more sophisticated mRNA vaccinations available.
We have to remember that China has been protected the public for so long. There has been no herd immunity in China. So this is going to start. And this process is not going to be smooth. It will be quite difficult.
With the sudden dismantling of COVID restrictions, including mandatory PCR testing to enter public spaces, China is bracing for a surge in infections and deaths. More than 2 million fatalities by one estimate. Criticism of COVID-0 is rapidly being replaced by concern that the rapid policy shift away from the all-out eradication of the virus is happening too fast, and that China is ill-prepared, like Hong Kong was back in March, for a health crisis of unseen proportions. Stephen Engel, Bloomberg News, Hong Kong.
An important report there from our colleague Stephen Engel on just how bad things could get in China. We'll get back to the markets shortly. We'll get you analysis with Kokou Agbo-Bloua. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. What will the Fed do next? Investors hope key inflation figures due out today may provide a clue. The big freeze, Europe may be able to fight it off because of huge stockpiles of natural gas. And the UK unveils more than 30 post-Brexit reforms aimed at boosting the financial services industry. What will the so-called Edinburgh reforms mean for UK finance? I'm Anna Edwards in London with Matt Miller in New York. Kailey Leinz is off today. And Matt, we're all about inflation, it seems, today. We have PPI data due out the United States later on. Overnight, we got the CPI and PPI data out of China looking sluggish, prompting talk of more stimulus to come. And through that, stocks make modest gains.
Yeah, maybe waiting for PPI is why we're not seeing the kind of gains that we saw here yesterday again, or the kind of gains that we saw in Asia overnight. We were looking at 1-2% gains in Asia, and here on futures, we're only looking at about 0.25%, but we're really waiting for that PPI number. As Valerie Teitel told us, it really could be a game changer for Fed policy, and of course, CPI comes out after that. We're looking at a 10-year yield that is coming down just slightly. It had been rising a little earlier, but also not a lot of movement here, right? 347.06, we were at 348 earlier. We're just holding around this 350 level basically over the last couple of weeks. NYMEX crude at 72.18. Right now, that's up 1%, but such a low level that before this week, we hadn't seen that since 2021, a 72 handle on oil. And then Bitcoin climbing up and holding above 17,000. I think it's really interesting, 17,218. That hasn't helped analysts' view of Coinbase, which they see having lower volumes, at least at Mitsuo, and so they've downgraded Coinbase to an underperform. Take a look, speaking of that, at some of the pre-market movers here. Microsoft and Activision, I'm just keeping an eye on because the FTC is concerned about the purchase, Microsoft's $69 billion purchase of Activision. Putting that on ice could hurt, obviously, the shares in Activision. As a result, they're down in the pre-market just a little bit, but wait until this thing opens. And I think it's such an interesting case, right? Because regulators are concerned about whether Microsoft would have control over the most important video games in the world and whether or not they would let other people into those games for revenue sharing purposes. Is just such an interesting IP thought experiment. Netflix right now is gaining. It got an upgrade over at Wells Fargo. They say that next year there should be less churn and more stability in terms of subscribers. So Netflix up 2% in the pre-market. And then DocuSign up more than 10%, up more than 12% actually right now in the pre-market because they have raised their full year revenue guidance. So that stock could be off to the races at the bell. Anna, what do you see in Europe?
Just interesting on Netflix, a decent move there. And just in the week that we hear from Harry and Meghan, that's getting all the Netflix coverage over here in Europe. This is what we see in Europe, up by 0.4% on the stock 600 right now. Off earlier lows, in fact. Energy stocks not doing too badly. Brent crude on the rise. That's also off earlier highs. And we've got 76.51 is where we trade on Brent. We have not seen these kind of levels since the start of the year. To your point, Matt, we've come quite a long way when it comes to climbing up the hill on Brent and then coming back down, or on oil products more generally. And in fact, we just started the week with an 85 handle on Brent. So quite a substantial, speedy move, despite all of the narrative around reopening in China. Just shows how nuanced that story is. Credit Suisse is rising, up by 3.5%. They managed to do their capital raising, 4 billion Swiss francs in capital raising, more than 98% of that going to existing shareholders. New ones coming in too, though, of course. And Man Group is up by 6.7%. And this company saying that they're going to be doing a buyback, and that is proving popular with investors, Matt.
All right, we'll continue to watch all of those shares as well. Joining us now is Kokou Agbo-Bloua, head of UK research at Societe Generale. Kokou, thanks so much for coming on the show this morning. What do you think about as Lynn Thomason from our stocks team was saying earlier, the main tug of war in these markets, kind of the reopening of China and the possibility that that boosts demand, and at the same time, the tightening of central banks and the possibility that that causes a recession? Is that the main argument in markets today?
Well, I think it is pretty much. I think it is also a question of the resilience of corporate and household balance sheets, the significant amount of excess savings that is cushioning the inflationary pressure in the cost of living crisis. And then you also have to factor in the fiscal policies with all the measures, like in Germany, 200 billion euros of energy shield to protect against the rising cost of energy. So I think it's also a question of timing, because it takes 3 to 5 quarters for interest rates to hit the economy. So this is why we're expecting a recession more towards the first quarter of 2024 for the US. Clearly, the UK and Germany are already to some extent in a recession. But if you look at the broad economy, these two forces are offsetting each other, and the debate with investors is how big a demand destruction are we going to see towards the second half of next year? And that will determine the path of inflation and then monetary policy. But at the current juncture, the view is for interest rate to plateau from Q2 next year. That will be the first pivot. And then the second pivot will be actual cutting of interest rates as we start to see evidence of a recession or a slowdown in growth.
Well, if we don't start to see a recession in the U.S., Kokou, until the beginning of 2024, does that mean, your second pivot, which is really the only pivot coming back down, does that mean we don't see that in 2023 from the Fed?
Yes. So our view is that the rate cuts will essentially occur in 2024. I think the yield curve is sort of expecting a cuts towards second half of next year. But for us, we think it is too early, because if you look at the strength or the kinetic energy, so to speak, of the U.S. economy from a jobs perspective, the fiscal stimulus that is embedded in the economy, and also I think that's also very important. It is the corporate profit margins. They are incredibly resilient because of the operating leverage driven by inflation. In other words, nominal revenues are growing faster than wage inflation, and therefore earnings are essentially being inflated by inflation. And this allows, despite the input cost crisis, businesses to have resilient earnings. So we're expecting earnings to grow at close to zero next year, but it is to put into perspective with valuation having already been derated.
So Kokou, good morning. So you think that resilience in corporate earnings, that is something that can continue into next year, despite all of the cost pressures, because you think that revenues also climb?
Yes, in other words, I think if you look at real earnings growth, they are already negative because inflation is around 10%. But we are looking at things nominally. And this is one of the beauty of corporate, or let's say the income statement and the way inflation feeds through an income statement of a company. So our view is that, in other words, we will see demand destruction and a slowdown, but it is more than offset by the pricing power that some companies have been able to use. And this is called greedflation. In other words, the ability of companies to raise prices by more than what the increase in their input costs would suggest.
Greedflation. I'm sure they call it something else, but it's a point well made, Kokou. Let me ask you about China and the reopening story there. We just carried a report by one of our colleagues in Hong Kong, casting his mind back to how stressed and strained the medical system in Hong Kong had become during peak infection. And we now brace to see how many infections and then, sadly, how many deaths we see in China. So given all of that, what does the trajectory of the reopening story look like for you then, Kokou?
Yeah, our view is that it's going to be a gradual reopening. Clearly, the path of least resistance is for reopening because the social tension is something that's unbearable going longer term. I mean, they've been literally in lockdown mode for over 2 years now. When you look at what happened in the Western world, sort of a couple of months created a lot of psychological pressures already. But the thing is, as you mentioned earlier, it will lead to a number of deaths. But the assumption is that they will ramp up vaccination, because this is something that was not done as a priority around the sort of party congress review, etc. So as they pick up mass vaccination, that is hopefully will plateau or will lead to a more manageable path of death, which is something they've been trying to avoid. So in other words, the impact on commodities and oil on all markets is not going to be as aggressive, and the sort of stimulus towards global growth is not going to be as aggressive as most people expect. It's essentially more of a gradual reopening and a tedious reopening, unfortunately.
Kokou, what do you think about the performance of the stock market next year? When we ask strategists, they tell us next year is going to be a drop for the first time since 1999, the first time that strategists are bearish about the following year in our survey. When we ask fund managers, they say we're going to see double-digit gains, albeit low double-digit gains, nonetheless, 10% up next year. Where does the stock market go, considering the economic expectations that you've outlined?
Yeah, our view is that the stock market will be range-bound or in a gradual downward drift. Because it will be subject to a death by 1,000 cuts, so to speak, because what we had in 22 was a valuation derating because of higher bond yields. What we're expecting next year is an earnings recession. As I said earlier, it takes 3 to 5 quarters for interest rates to hit the economy. You have a lot of offsetting factors, savings, corporate margin, high unemployment, but all of that will have to face the cumulative effect of tightening. And this is going to be a downward gravitational pull on earnings growth. And therefore, you could expect to see more profit warnings, for example, because CEOs typically have 3 quarters of visibility, or let's say 3 months of visibility in terms of their businesses. So valuation stabilizing because bond yield is stabilizing, but the earnings is the part of the equity market that will take a hit next year.
Kokou, thank you very much. Kokou Agbo-Bloua of Societe Generale. Good to see you. Thanks for spending time with us here on Bloomberg TV. Coming up on the programme, we will talk to the Goldman economist, Kevin Daly. He and the team have been setting their thoughts on the path to 2075. Yeah, not 2025, 2075. We'll get the long view. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Mercedes-Benz Group CEO Ola Källenius. That's at 8:15 a.m. New York time.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, Goldman Sachs economists have taken up the daunting task of predicting the path of the world economy through 2075. Among the highlights, they see global growth on a declining path. I thought these were highlights, averaging just under 3% a year over the next decade. That's down from 3.6% in the decade before the financial crisis. Let's get other details now on this ambitious project. Kevin Daly joins us, co-head of CEEMEA Economics at Goldman Sachs. That's Central, Eastern Europe, Middle East, Africa, and perhaps some other places beyond. Kevin, very nice to have you with us.
Good to see you, Anna.
So why 2075? Why embark on this project?
So, I mean, this is an extension of the original work by Jim O'Neill and team on the BRICS projections, which he first made 20 years ago with his colleagues. They originally projected out to 2050, and as it's close to 20 years on from those original projections, we thought we'd extend it further to see 50 years into the future.
Is declining population growth one of the biggest assumptions you make here, and one of the biggest pieces, one of the biggest assumptions that has an impact, I suppose, on where the future economy goes?
Absolutely. So one of the key themes, one of the key themes that you highlighted in the introduction is we do see slower growth over time. Most of that slowdown is driven by slower population growth. Population growth has already fallen from around 2% per year around 50 years ago to 1% per year now. The UN projects that it will fall to close to zero by 2075.
And even in some quite emerging markets, we're seeing population growth.
Well, China in particular, for instance, you see quite a rapid slowdown now. Within the piece, we describe this as a so-called good problem to have, in as much as, for long-term environmental sustainability, we do need population control. But nevertheless, it will present some pretty challenging economic challenges for economies dealing with population aging, dealing with the slowdown in growth that involves.
OK, Matt, jump in.
Well, it just shows you how quickly concerns can change, right? Because I remember, Bad Religion put out a song about 20 years ago called 10 in 2010. They were so worried about an explosion of population growth. And now we're worried about the opposite. Does this?
I wouldn't say I wouldn't say we're worried about it. I do think it, as I say, I do think it is a necessary evil in some sense over time that we do get population control, for environmental sustainability. What is interesting, though, is that not only are we seeing a slowdown in population growth, but actually the projections over time from the UN are also slowing. So they previously saw population rising to 11 billion by the end of this decade. Now they see it peaking at around 10 billion, and over time those projections are now declining.
This flies in the face, though, of my vision for the future, my Wall-E world vision, where the robots and the AI are doing all the work, so we humans just lounge around. The picture you're painting is more like one we're seeing in the JOLTS data, right? Where we have millions, maybe even tens of millions of job openings that can't be filled. Is that what we're looking at?
No, I should emphasize this is that there is a lot. Wall-E, it was a great film, a somewhat dystopian vision of the future, though. So I'm not sure that's something we should be hoping for.
But the point being, the tech does all the work for us, Kevin, and you're saying that a slow labor force is a problem.
Yeah, but we do see productivity growth over time, and within any exercise such as this, we should emphasize the uncertainty inherent in any long-term prediction of this kind. One of the advantages, however, of making these long-term forecasts is that we exclude a lot of the cyclical uncertainty that we think about pretty much in your show today. You've spent a lot of time talking about China, COVID reopening. That is, how China reopens to COVID. Whether that process goes well is critically important for next year's growth in China, but it's much less important for where GDP growth will be in 10 or 15 or 20 years' time. And that's one of the advantages of looking within this modelling at things like labour dynamics, capital dynamics, and productivity, which computerization and robotics will influence over time.
Well, let's go to that in our conversation then, because I started looking at what you're saying about population and then thought, well, do we need a new economic model here? Because if growth is driven by population increases or productivity growth, if we can't rely so much on the former, we have to rely a lot more on the latter. Is that what the next 25 years look like, and that's what people have to get right.
Yes, and productivity is always critical to growth. And some of the slowdown we've seen over the last 10 years, some of it has been due to population, but some has also been due to slower productivity. And one of the challenges that we face going forward, one of the key risks that we highlight within the piece is, there is now a battle against globalization, resistance to globalization. We argue within the piece that globalization has been very good in terms of boosting EM income levels and therefore reducing global income inequality. But it probably has been associated as well with the rise of local inequality within nation inequality. And that has resulted in an understandable backlash against globalization, which policymakers need to address, need to focus on. And it is one of the risks going forward that this backlash against globalization, an increase in populism, an increase in localization will reduce trade and reduce productivity growth over time. But hopefully, we've been relatively cautious in our productivity assumptions within the model, so I think there are risks both to the upside and to the downside. But as a central case, we do see slightly slower productivity growth.
OK, Kevin, thank you very much. Thanks for bringing us your analysis. Kevin Daly of Goldman Sachs, taking the long view. Now, coming up, how are the world's top money managers feeling about 2023? We touched on this story a couple of times already, but we'll get all the details. We have the latest Bloomberg survey. That's coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kailey Leinz is off today. Let's get a look at what's ahead. At 8:30 a.m., we're going to have the U.S. PPI reading for November, so one look at inflation. Then at 10 a.m., we'll have the U.S. wholesale inventories, or inventories, as you would say in England, as well as the University of Michigan Consumer Sentiment Surveys. They are some of the final pieces of data that the Fed officials will see before next week's December policy meeting. Anna?
It's OK. You don't need to speak English just for me. Now, the latest Bloomberg Fund Manager Survey shows optimism for the year ahead, but worries about stagflation. Some of the world's biggest investors predict that stocks will see low double-digit gains next year, which would bring relief after global equities suffered their worst, or look as if they're going to suffer their worst loss this year since 2008. Jan-Patrick Barnett joins us. He's been covering the details of this really interesting survey then of fund managers. JP, what is the general tone then that this survey reveals?
Well, I would say it's like cautiously optimistic or constructive view, if you want to put it that way. So 71% said that they believe the market will go higher next year. And then the 10% sounds nice. But if you keep this in context with like other rebounds in 2009, for example, or 2019, where stock markets rallied 30 and 20%, it seems rather modest. Also, we had like many participants in the survey saying like, well, we are bullish, but we believe that some of those gains are going to be rather skewed to the second half of the year. And they are predicting some wobbles in the first 2 quarters with the economy cooling and the path of inflation still a little bit unclear.
So, and this is a survey of a global survey, right, Jan-Patrick? Where do fund managers see the gains, or are they evenly spread throughout the earth?
Yeah, that's also interesting that when we asked like where they want to put the money, where their favorite spot is, so to speak, to put the money, most answers were rather defensive. So healthcare was named a lot. We saw a lot of dividend names and high quality stocks, basically everything that is able to defend a good balance sheet, to produce good returns, even with an economic slowdown. We asked about US tech. A majority said like they would still go back in, but not as in a broad approach, but rather be selective and make sure again here that you pick those growth companies and those tech companies that are able to produce good earnings even in a difficult environment. We also asked about China. Big majority here still wants to go back in, but many said like, let's wait a little bit and see how that COVID opening story is going to play out.
OK, thanks very much. Jan-Patrick Barnett joining us there with the latest on what fund managers expect from the markets. He talked about COVID reopening. Interesting story just crossing the Bloomberg. Tesla to suspend output at its China factory later this month. Tesla will suspend output in stages at its Shanghai EV factory from the end of the month until as long as early January. This, according to people familiar with the matter. We'll keep an eye on all things Tesla, all things Elon Musk, of course, for you. This is Bloomberg.